All right, welcome to the Explainer. Today, we're going to pull back the curtain on a professional method for trading cryptocurrency and show you how to see the market the way the algorithms really do.
Okay, let's kick things off with a pretty stark reality from our source material. The crypto market? It's not just you against other people. The game is absolutely dominated by sophisticated trading algorithms. We're talking over 80% of all trading volume. Think about that for a second.
So, that begs the question, right? If you're basically swimming in a pool full of sharks, these bots, how on earth do you compete? Well, here's the secret. You don't try to outsmart them. That's a losing battle. Instead, you learn to understand how they're programmed, because they follow a very specific set of rules that, honestly, most retail traders have no idea about.
And this brings us to a tool that almost everyone has in their charting toolbox, Fibonacci retracement. Now, a ton of traders use it, but the way most people apply it actually makes them super predictable and really vulnerable to the very algorithms they're trading against. Let's dig into why.
Okay, so here's the night and day difference. On one hand, you have the typical retail trader. They're obsessed with the golden pocket, that 0.618 level, and they're always drawing their fibs on the latest little price move. On the other hand, you have the pros and the bots they build. They're focused on the 5 level, the equilibrium, and they're hunting for liquidity from way older, untested price swings. It's a completely different map of the market.
And see, that's the whole disconnect right there. The bots just aren't programmed to look for the same things you might be. This is exactly where most traders lose their money and their edge. But it's also, if you pay attention, where you can find a brand new, powerful one.
So what's the secret sauce here? What is that edge? According to the source, it all comes down to shifting your focus from what's happening right now to what happened much, much earlier in the price action. And this is the core concept you need to grasp, the untested fib. It's simply a Fibonacci level from a big previous price swing that price has never come back to touch. These levels are like magnets because they mark spots on the chart with hidden, untapped liquidity that algorithms are literally programmed to go hunt for.
Okay, let's look at this chart right here. A normal trader would be drawing their fibs on that most recent little pump. But a pro, they're looking way back at this earlier swing. You see that 0.786 level? Price shot up and never came back to check on it. That left behind a giant pool of orders, liquidity, that the algorithms have stored in their memory. They will come back for it later.
So, and this is super important, not all fib levels are created equal. The source is very clear. Bots are specifically programmed to react to these 4 zones, the 0.5, the 0.618, the 0.705, and the 0.786. For now, you can almost forget the others. These are the levels that really matter.
And here it is, the big paradigm shift. The most important level for these algorithms isn't the one everyone on YouTube talks about, the golden pocket. No, it's the 0.5 level, the equilibrium. That's the true 50-yard line, the balance point of a range that bots are designed to return to over and over again.
Now, this is where it gets really interesting, because Fibonacci levels are never used by themselves. They aren't the magic bullet, they're actually just a confirmation tool for something way more important. This quote from the source material, you almost need to tattoo this on your brain. Liquidity is king, always. Fibs are just confluence. Your analysis has to start with finding where the money is. The fibs come second, every single time. They confirm your idea, they don't create it.
So what do we mean by confluence? It's just a fancy word for when multiple different signals all line up and point to the exact same spot on the chart. A pro trader is looking for one of those key untested fib levels to line up perfectly with a liquidity zone they've already found, something like a big order block or a fair value gap. When you get that alignment, the probability of price reacting there goes through the roof.
So this isn't random guesswork. It's a systematic process. Step 1, and this is non-negotiable, identify liquidity first. Find those key zones on the higher time frames. That's your reason for even looking at the chart. Step 2, then you draw your untested fibs from those big old swings, hunting for levels that overlap. And step 3, the most critical part, confirm the confluence. A trade is only a go if that fib level perfectly confirms the liquidity zone you found in step 1.
And boom, check this out. This Bitcoin chart is the perfect example. The reason for the trade idea is that big fair value gap. But look what confirms it. The 0.5 fib, the equilibrium, lines up perfectly with the middle of that gap. That is an A+ high probability target that an algorithm is almost guaranteed to aim for. That is confluence in action.
When you start combining these concepts, something amazing happens. You stop just reacting to what the market is doing, and you start anticipating its next move, just like an algorithm is programmed to do.
Just look at the price action on this SUI chart. Look how price just snaps to these untested fib levels, one after another with incredible precision. That's not random. That's not a coincidence, folks. That is a visual representation of a program executing its code, moving methodically from one predefined target to the next.
And here's another fantastic example on Pendle. Every single one of those pullbacks after a new high, it wasn't a guess where it would stop. It was a calculated surgical move down to a specific fib level. The algorithm was just cleaning house, clearing out liquidity before feeling up for the next leg higher. This is how you can forecast these moves.
And that's the ultimate goal, isn't it? By identifying these future levels, where the liquidity and the untested fibs align, you can plan your trades way in advance. You totally flip the script. You go from being the liquidity that gets hunted to being the one who's doing the hunting. Okay, so let's boil all of this down. After all this, what's the key takeaway? What's the new edge you can walk away with and start applying right now?
It really comes down to these 5 simple rules. Rule 1, liquidity is king. Say it again. Always start there. Rule 2, you're a detective now, hunting for those old, untested fibs on the higher time frames. Rule 3, fibs are just for confirmation. That's it. Rule 4, your new favorite level is the 0.5 equilibrium. That's your new golden pocket. And finally, Rule 5, think like an algo. Plan your moves in advance at levels the average trader doesn't even know exist. Master these, and you've got a serious edge. And we'll leave you with this final thought to chew on. Now that you know the hidden professional way to use a tool as common as Fibonacci, it makes you wonder, right? What other tools in your trading arsenal are you maybe using the retail way? It's a question definitely worth asking.